Thanks for clicking! Canada's 40-year high inflation rate was due to supply shocks and not money printing. This according to a multitude of releases coming from the Bank of Canada.
I didn't do anything wrong.
Indeed, in very short order on Thursday, Deputy Governor Sharon Kozicki offered a speech going over the effects of quantitative easing. We had a staff analytical note released on the sources of pandemic-era inflation, and another staff analytical paper released on the central bank purchasing bonds. Or, as Bloomberg put it,
top official at the Bank of Canada says more interest rate cuts are on the table if inflation continues to ease. In a speech this morning,
yeah, we didn't see much in the media questioning the assertions being put forward by the Bank of Canada, instead focusing on summaries of what the Bank of Canada had to say.
My daddy wouldn't tell me anything that wasn't so.
But the timing, coordination, and extent to which the Bank of Canada has sought to address pandemic-driven inflation is definitely a little curious. And if the media isn't going to offer any insight, we'll do it ourselves. So what I want to do today is go over Kozicki's speech, take a look at the two studies on quantitative easing and pandemic-driven inflation, and then discuss some remaining questions.
How f***ed up are you?
Speaking of remaining questions, we are eagerly awaiting the release of Canada's inflation data for the month of May, set to be released next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this speech. On to the speech. Kozicki began the speech by going over the exceptional circumstances being faced by the Bank of Canada at the beginning of the pandemic, and noted that with interest rates already as low as they could go, the central bank turned to quantitative easing and forward guidance.
But when policy interest rates are as low as they can go, central banks need other tools to add stimulus.
Nothing to worry about.
And for this, a very, very brief refresher on bond yields is in order. Remember that a bond's price and its yield are inversely related. So, as the price of a bond goes up, its yield goes down. Say I have a government bond for which I paid $100 and it has a 10% coupon. At the end of the period, I'm going to get $110 back. I am yielding 10%. But Jen comes along and needs a good place to stash her money, and she really wants my bond, so she pays me $105. Jen is still going to get $110 at the end of the term, but she's only going to be yielding 4.7%. So Jen is yielding less money than I was going to, as she paid a higher price for that bond. And that's what the Bank of Canada did during the pandemic with government bonds. As we've discussed so many times before on this channel, and is persistent news to the real estate industry, the Bank of Canada does not control longer-term rates. It only controls short-term rates. As such, during the pandemic, with the Bank of Canada wanting to not only fund government spending, but also lower long-term interest rates, the bank entered the bond market, bidding up the prices of bonds, sending yields to the floor.
Under QE, a central bank buys a lot more government bonds than usual. This bids up the price of the bonds and lowers their returns or yields.
So yeah, in a normal bond market, it's just you and I, maybe a few banks, some pension funds, trading bonds amongst ourselves. But enter the money printer, the only entity legally allowed to just create money out of thin air, and it can buy bonds for higher prices, as its supply of cash is basically unlimited. So the Bank of Canada entered into the bond market, started paying artificially high prices for bonds, which sent yields downward, making fixed-rate borrowing for the government, for you and I, incredibly cheap.
Nope, it was all me.
And that cheap borrowing is where the Deputy Governor turned to the increase in the money supply, which, according to basic knowledge of economic history, common sense, and a report from TD, that increase was a major cause of pandemic-fueled inflation, except maybe not so much, according to Kozicki.
Now, before moving on, I'd like to comment more generally on money growth and inflation. I'm not going to pretend that we got everything right. The pandemic response was challenging. But the evidence suggests that the run-up in inflation that started in 2021 was mainly driven by supply-side issues, including commodity price swings and supply disruptions.
Well, there is a bit to unpack here. First off, the evidence to which Kozicki is referring is in the footnotes of that speech, which points to a study published by the Bank of Canada, which we'll get into later, and another one published last year. And I suppose that if you're the central bank, you do have a fair bit of authority, but Ideally, especially when you're a central bank, which the governor even admits already has some trust issues, ideally, you'd use a source other than yourself when trying to support an admittedly controversial point, though that could be a fairly tall order. And the other source used by the Bank of Canada, published last year in the Canadian Public Policy Journal, puts the blame for inflation primarily on shelter and energy. And yeah, shelter, that's a fairly important source of inflation about which Canadians are fairly concerned, which, as we found out when the bank started raising rates, house price inflation was due, in fact, to low interest rates. And a brief look at the CPI basket shows that the price of non-energy related items were shooting up even before 2022. So the bank is saying that the inflation that we saw was not in fact caused by money printing, and uses two sources, one of which it conducted itself, and the other of which says that inflation was due primarily to high shelter and high energy costs. Not exactly definitive sources.
Trust me.
Kozicki then, for whatever reason, moves on to note that the money supply had increased for the past 30 years, and yet we didn't see inflation during those times.
When we look at the last 3 decades, we see very little correlation between money growth and inflation. Put another way, money growth has not been a reliable indicator of future inflation.
And that's just a very weak argument.
Everything that guy just says bull.
And I suspect the deputy governor knows this is a weak argument. For one, there is a big difference between this money growth and this money growth. And two, as many have pointed out, globalization puts downward pressure on prices. With China and the developing world exporting lower priced goods to the rest of the world over the past 30 years, and Canada increasing its imports from China by 12-fold over those 25 years, that is going to put downward pressure on prices, regardless of the level of the money supply. Further, if the Bank of Canada wants more information on the disinflationary pressures of trade with China, it can consult with the Bank of Canada in 2009, when it found that the integration of China into the global economy, including prices in competition with domestic firms, has worked to reduce inflation. Or it can speak with the Bank for International Settlements. The governor actually attended a conference there last week. Or it can talk to TD, which said last year that the bank will no longer be able to depend on trade to dampen prices given global pressures. Or it can speak to a recent Bank of Canada report, which acknowledged massive impact on value change brought on by the integration of China since the 1990s. So yeah, you can increase the domestic money supply when you're offsetting inflationary pressures by the import of cheaper goods from other countries, which obviously wasn't happening during the pandemic as everything was shut down. Kozicki then went on to discuss accountability and transparency before throwing some meat to John Ehrlichman of Bloomberg, noting that the bank might cut rates if inflation keeps on the downward trend.
That's all I know. That's all I need to know.
So, the bank is at least acknowledging that the increase in the money supply was at least partially contributory to the pandemic-fueled inflation, but it's making the point that supply issues were the dominant culprit, a point which it reiterated in its paper assessing the impacts of the Bank of Canada's government bond purchases. The paper found that the bank's bond buying program, the quantitative easing, contributed 1.8% to Canada's overall inflation rate, though even the paper admits that we should take these estimates with a grain of salt, as there is a great deal of uncertainty about the relationship between quantitative easing and inflation.
The jury is still deliberating.
Well, the Bank of Canada did actually put out a new study on this relationship, referenced by Kozicki, which seeks to apply a model measuring pandemic sources of inflation. The model, authored by former Fed Chair Ben Bernanke and Olivier Blanchard, or Blanchard, I don't know, well known for his calls to raise the inflation target.
Brilliant guy.
In the Bank of Canada's application of that model, they found that energy, food, and shortages were the main contributors to inflation, rather than the vacancy to unemployment ratio, which Bernanke and Blanchard used as a measure of labor market pressure, a measure of labor market tightness. Now, this really isn't the place to do an extensive review of the Fed chair's model, but suffice to say, the model is not without its critics, by any means. Regardless, as mentioned at the beginning of the video, the timing and coordinated release of these reports is definitely curious. Why all three at once?
Plan things out. Make no mistakes.
The media wouldn't read or notice, regardless of when they were released, so why the coordination? Further, why the part about the money supply increasing over the past 3 decades without the ensuing inflation, make it into the speech when the difference between the two periods is massive. The Deputy Governor noted that the bar for the Bank of Canada to use quantitative easing again is very high, though, and I say facetiously, I can't see why. If we can borrow at zero rates, expand the money supply, send house prices to the moon ad infinitum without inflation, which was caused just by supply shortages, then why not do it forever?
Yeah.
I said I was being facetious. Regardless, the bank appears to want us to know that the pandemic-driven inflation was not a result of quantitative easing. The resulting increase in the money supply was not the main culprit of the price increases. My guess is that there is a worry out there that if the Bank of Canada ever does have to re-engage in quantitative easing, that they're worried that that will set off inflationary expectations, which they're quick to note remained well anchored during the pandemic.
My daddy wouldn't tell me anything.
With that said, I don't want to engage in any wild speculation, but suffice to say, the bank wants us to know that it doesn't think these major increases in the money supply, the hundreds of billions of dollars worth of quantitative easing, which they're now fighting with quantitative tightening, was the reason for the pandemic-fueled inflation. Why they want us to know that so badly that it would necessitate a coordinated policy effort on a single day remains to be seen, but we'll continue to track Bank of Canada policy on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.